U.S. Treasury bills might sound boring, but they're one of the most powerful tools in global finance. And lately, they've also become a tool of geopolitical pressure. Here's how it works. When you buy a T-bill, you're basically lending money to the U.S. government. In return, you get it back with interest. It's considered one of the safest investments in the world. That's why countries like China and Japan hold trillions of dollars in U.S. government debt. But what happens? When a country like China starts selling, first bond prices fall. That pushes interest rates up because the U.S. has to offer better yields to attract new buyers. That affects everything from mortgage rates to credit card interest. Second, a large sell-off can shake global confidence in the dollar and trigger volatility in the markets. During periods of trade tension like the U.S.-China tariff war, China has hinted at selling U.S. treasuries as a form of leverage, not just to hurt the dollar, but to signal that it can push back economically without firing a shot. Now, to be clear, China hasn't dumped its holdings in full. That would hurt them too. But even the threat of selling can move markets. So why? Should you care? Because when yields spike, your borrowing gets more expensive. Student loans, mortgages, auto loans. And if confidence in U.S. debt weakens long-term, that could put pressure on the dollar, and eventually, more inflation. T-bills aren't just a tool for governments. They shape the financial world you live in, whether you notice them or not.